What is the gold standard? Advantages, alternatives, and history part 2. Gold versus the US dollar. As World War II was coming to an end, the leading Western powers met to develop the Bretton Woods Agreement, which would be the framework for the global currency markets until 1971. Within the Bretton Woods system, all national currencies were valued in relation to the US dollar, which became the dominant reserve currency. The dollar, in turn, was convertible to gold at the fixed rate of $35 per ounce. The global financial system continued to operate upon a gold standard, albeit in a more indirect manner. The agreement has resulted in an interesting relationship between gold and the US dollar over time. Over the long term, a declining dollar generally means rising gold prices. In the short term, this is not always true, and the relationship can be tenuous at best, as the following one-year daily chart demonstrates. In the figure below, notice the correlation indicator, which moves from a strong negative correlation to a positive correlation and back again. The correlation is still biased toward the inverse, negative on the correlation study, though, so as the dollar rises, gold typically declines. At the end of World War II, the US had 75% of the world's monetary gold, and the dollar was the only currency still backed directly by gold. However, as the world rebuilt itself after World War II, the US saw its gold reserves steadily drop as money flowed to war-torn nations and its own high demand for imports. The high inflationary environment of the late 1960s sucked out the last bit of air from the gold standard. The gold pool. In 1968, a gold pool, which included the US and several European nations, stopped selling gold on the London market, allowing the market to freely determine the price of gold. From 1968 to 1971, only central banks could trade with the US at $35 per ounce. By making a pool of gold reserves available, the market price of gold could be kept in line with the official parity rate. This alleviated the pressure on member nations to appreciate their currencies to maintain their export-led growth strategies. However, the increasing competitiveness of foreign nations combined with the monetization of debt to pay for social programs and the Vietnam War soon began to weigh on America's balance of payments. With a surplus turning to a deficit in 1959 and growing fears that foreign nations would start redeeming their dollar-denominated assets for gold, Senator John F. Kennedy declared, in the late stages of his presidential campaign, that he would not attempt to devalue the dollar if elected. The gold pool collapsed in 1968 as member nations were reluctant to cooperate fully in maintaining the market price at the US price of gold. In the following years, both Belgium and the Netherlands cashed in dollars for gold, with Germany and France expressing similar intentions. In August of 1971, Britain requested to be paid in gold, forcing Nixon's hand and officially closing the gold window. By 1976, it was official. The dollar would no longer be defined by gold, thus marking the end of any semblance of a gold standard. In August 1971, Nixon severed the direct convertibility of US dollars into gold. With this decision, the international currency market, which had become increasingly reliant on the dollar since the enactment of the Bretton Woods Agreement, lost its formal connection to gold. The US dollar, and by extension, the global financial system it effectively sustained, entered the era of fiat money. Who still has the gold standard? No country currently uses a gold standard. As mentioned above, Britain terminated the gold standard in 1931, and the US did the same in 1933. In 1971, the US fully severed the direct convertibility of dollars into gold. In other words, no country backs its currency by gold. In the US, currency is backed by the government and its ability to continually generate revenue. What are the advantages and disadvantages of the gold standard? Proponents of the gold standard argue that it prevents inflation, as governments and banks are unable to manipulate the money supply, such as by overissuing money. The gold standard also stabilizes prices and foreign exchange rates. On the other hand, under the gold standard, the supply of gold cannot keep pace with its demand, and it is not flexible under trying economic times. Also, mining gold is costly and creates negative environmental externalities. Why did the US abandon the gold standard? The US abandoned the gold standard in 1971 to curb inflation and prevent foreign nations from overburdening the system by redeeming their dollars for gold. What would happen if we returned to the gold standard? Though it is highly unlikely for the US to return to the gold standard, the idea has drawn some attention and popularity in recent years. Most notably, Judy Shelton, an economic advisor to former President Donald Trump, is known for her support for a return to the gold standard. In 2019, Trump nominated Shelton to the Fed, but she ultimately did not retain enough support. A return to the gold standard would limit the Federal Reserve's ability to print money and constrain its ability to enact monetary policy during critical economic events, such as recessions. Economists have also posited that a return to the gold standard would result in an economy that is more volatile, due to vulnerability to shocks in supply and demand for gold. Central bankers and economists are largely unanimous against the idea of returning to a gold standard. Did the gold standard cause the Great Depression? The Great Depression, the longest and most severe economic recession in modern history, was caused by a confluence of factors, with the gold standard being but one contributing element. Economists do not agree on a single explanation for the catastrophe, but have noted that its key causes include the stock market crash of 1929 and protectionist trade policies. The gold standard also played a role in the Great Depression, as it limited the ability of monetary policy to stabilize the economy. The bottom line: while gold has fascinated humankind for 5,000 years, it hasn't always been the basis of the monetary system. A true international gold standard existed for less than 50 years, from 1871 to 1914. Though a lesser form of the gold standard continued until 1971, its death had started centuries before with the introduction of paper money, a more flexible instrument for our complex financial world. Today, the price of gold is determined by the demand for the metal, and although it is no longer used as a standard, it still serves an important function. Gold is a major financial asset for countries and central banks. It is also used by the banks as a way to hedge against loans made to their government and as an indicator of economic health. Some also see gold as a potential investment vehicle that can help diversify their portfolio. Gold has a long-standing relationship with the US dollar, and, over the long term, gold will generally have an inverse relationship. With instability in the market, it is common to hear talk of creating another gold standard, but it is not a flawless system.
Friends, thanks for watching. Please subscribe my channel for more videos.